The consensus narrative about Dubai is that it operates on proximity. To extract massive returns from the emirate, the assumption is that you need elite local relationships, sovereign wealth access, or inside information. This assumption feeds directly into the implied guarantee trap. For decades, global banks and foreign investors looked at the scale of these developments and priced Middle Eastern corporate credit as if the sovereign wealth of the state implicitly backed every major project. We can reconstruct 5 specific trades executed by international funds between 2007 and today. Each trade exploited a distinct dislocation in currency, credit, equity, or tax structuring. The firms that generated outsized alpha in these specific windows did not possess better models or deeper Rolodexes. They extracted millions because they were reading the primary source legal and regulatory documents that the relationship banks ignored. In 2007, the global financial system treated the UAE dirham's fixed peg to the US dollar as a permanent, unbreakable law of regional finance. That year, the macroeconomic mechanics of the peg created a severe structural tension. A domestic construction boom pushed UAE consumer price inflation toward 12%. Meanwhile, the early tremors of the subprime crisis forced the US Federal Reserve to cut interest rates. Because of the peg, the central bank of the UAE had to mirror the Fed's rate cuts exactly when domestic inflation demanded tighter monetary policy. Real interest rates in the Gulf rapidly turned negative. In May 2007, Kuwait unilaterally dropped its dollar peg in favor of a currency basket, immediately strengthening the Kuwaiti dinar. Speculative capital instantly flooded the broader Gulf, betting the UAE would be forced to coordinate a similar revaluation. Hedge funds executed a massive hidden carry trade. They bought dirhams forward, using contracts that lock in a future exchange rate, while simultaneously accumulating high-yield UAE central bank certificates of deposit, capturing a 4.5% annual coupon on a currency they expected to appreciate. The scale of this trade was confirmed in a technical paper published by the Bank for International Settlements. The UAE assistant governor admitted on the record, "Our CDs program was reviewed in 2007 as a result of the speculation on dirham revaluation. These flows were to a great extent sterilized." To defend the peg against the speculative attack, the central bank was forced to completely restructure its operations. They shifted to an active auction system and deliberately collapsed the CD coupon rates from 4.5% down to roughly 1%, draining the profitability of the carry trade. By March 2008, the global financial crisis reached a boiling point. Global liquidity dried up. Local banks desperately needed US dollars instead of dirhams, and the massive speculative positions unwound as capital fled. The peg ultimately survived, but the funds that exited early captured high-yield carry on a sovereign bet. The first major extraction of alpha from Dubai relied entirely on the mechanical constraints of a central bank's currency peg. Between 2004 and 2008, Dubai financed its physical expansion by borrowing approximately $80 billion. Dubai World, the government's primary investment holding company, accumulated $59 billion of that total debt load on its own balance sheet. International banks extended this credit based on an assumption. Because Dubai World was government-owned, the debt was priced as if it carried an impenetrable sovereign guarantee from the emirate itself. The establishment decree told a different story. Dubai World was a decree corporation. The specific legal language confirmed it carried absolutely no contractual government backing. The sovereign guarantee existed entirely in the minds of the lenders. This line chart tracks the cost of credit default swaps, a derivative that functions as insurance against a borrower defaulting for Dubai World. Leading up to the crisis, the spread flatlines at a complacent 70 basis points. The market was pricing in near zero risk of default. On November 25, 2009, the Dubai government formally announced that Dubai World would seek a standstill on $26 billion in debt obligations. The illusion of the implied guarantee evaporated instantly. With the legal reality exposed, the cost of insuring that debt exploded, surging 354 basis points to hit 654 on the announcement. Closing this short required extreme execution discipline. 19 days later, neighboring Abu Dhabi stepped in with a surprise $10 billion political bailout, which immediately compressed the spreads back down. The relationship banks lost massive sums by ignoring the decree. The offshore credit funds secured immense profits by reading it, isolating the legal fiction, and shorting the exact gap between the contract and the consensus. That same restructuring exposed another critical document misread. In 2006, Nakheel issued a $3.5 billion Islamic bond, oversubscribed 2.5 times by international investors eager for a piece of Dubai's real estate boom. This diagram illustrates a Sukuk al-Ijara, a lease-based Islamic bond framework. Investors believed they held an asset-backed structure, meaning physical property would be transferred to creditors if the issuer failed. The rating agency footnotes confirmed it was merely asset-based. Investors only possessed contractual rights against an offshore holding company, leaving them totally unsecured. Furthermore, the local insolvency regime at the time was legally inadequate to handle complex restructurings, requiring the government to suddenly establish a bespoke, unappealable tribunal. Creditors had zero physical assets and zero standard legal leverage. This panic created the third trade. Distressed debt specialists, like the ex-Deutsche Bank traders at SC Lowy, swept into the secondary market. They systematically bought the newly restructured paper from small, cash-starved contractors who couldn't afford to hold 5-year notes. The arithmetic was incredibly favorable. Distressed buyers acquired the legally flawed paper at roughly 80 cents on the dollar, locking in a 10% annual profit rate on the restructured terms. The trade paid off exactly on schedule. In August 2016, the Sukuk matured, and the secondary buyers received full par repayment. The distressed funds did not rely on the legal structure holding up in court. They achieved double-digit yields by monetizing the panic of the initial investors, who had signed contracts without reading the asset-based terms of their own securities. Moving into the modern cycle, the market bottomed in March 2020 amid global lockdowns and disrupted trade flows. As the economy reopened, a retail consensus formed. Investors poured heavy leverage into direct off-plan property. They committed to long-term payment schedules tied to construction milestones, banking on endless capital appreciation. This comparative bar chart reveals the institutional alternative. Emaar Properties offered a liquid proxy for Dubai real estate exposure. In mid-2023, the company's net asset value stood at $37.6 billion, towering over a compressed market capitalization of just $16.8 billion. Buying the listed equity from the 2020 low returned 4x the initial investment over 3.5 years. It captured the exact upside of the real estate boom, while completely eliminating the execution risk of physical construction. Direct off-plan buyers are now experiencing the inverse. They are locked into rigid, staged payment tranches. As regional geopolitical tensions rise, those who bought at the peak face severe paper losses, with no mechanism to exit without forfeiting their deposits. The institutional approach isolated the asset's specific value while retaining instantaneous liquidity. The structural ability to exit a trade immediately proved far more valuable than owning the physical concrete. The final ongoing trade in the region is divorced from market timing or specific financial instruments. It is a structural optimization of the asset management model itself, executed by migrating the fund's domicile. The split-screen ledger compares the math. In the UK, recent policy changes have pushed the tax on carried interest, the performance fee paid to fund managers, toward 34%. In the Dubai International Financial Center, or DIFC, funds face 0% corporate tax, 0% on capital gains, and 0% personal income tax. That ledger advantage is compounded by physical proximity. Relocating places portfolio managers in the same time zone and dining rooms as the active managers of $6 trillion in sovereign wealth. The result is a massive jurisdictional shift. Over 100 hedge funds, controlling $700 billion in combined assets under management, have relocated significant operations to the UAE free zones, rapidly scaling headcount even during periods of drawdowns. Physical presence anchors these sovereign capital relationships. When Abu Dhabi's Lunate committed $2 billion to a new platform run by Brevan Howard, it wasn't a remote allocation. It was a sovereign entity taking a direct equity stake in a manager operating exactly in their backyard. Across currency forwards, credit default swaps, distressed debt, equity valuations, and tax structuring, the edge remains identical. The market prices in an implied narrative. The actual mechanics, the lack of a guarantee, the definition of an asset, the limits of a peg, and the exact terms of a tax code are public record, sitting quietly in regulatory filings and technical footnotes. The next major market dislocation in the Gulf will not be a secret. It is already detailed in the structural documents. The outsized returns will simply go, as they always have, to whoever reads them first.